You can save $20,000 in tax today. 20 grand is no joke. You can avoid this legally too. You just have to understand the system like the wealthy. You have to know the rules. Here's what nobody tells you about taxes. Taxes aren't just about taking your money. They're the government's way of encouraging specific behaviors. Think of them as incentives wrapped in IRS code. Want people to save for retirement? Offer tax deductions for 401k contributions. Want people to invest long-term instead of day trading? Tax long-term investments at half the rate. Want people to start businesses and create jobs? Give them legal ways to reduce their tax burden. The wealthy understand this. The rest of us think we just have to pay whatever the government says. I will tell you 3 strategies you can implement, but before I do, let me show you what I mean by wealthy people play by the rules. Meet Larry Ellison, the founder of Oracle. He's worth over $200 billion in Oracle stock. If he sold just $10 billion of it, he'd owe $2.38 billion in capital gains tax. That's 23.8% on investment profits. Instead, he walks into a bank and borrows $10 billion using his stock as collateral. The bank charges him 3% interest annually, $300 million. Meanwhile, his Oracle stock grows at around 15% per year, $1.5 billion in gains. So he gets $10 billion in cash, pays $300 million in interest. His stock grows by $1.5 billion, and the IRS gets $0. Why? Because borrowed money isn't income. It's not taxable. This is called buy, borrow, die, and it's completely legal. Now here's the important part. You don't need $200 billion to use the same principle. The principle is this. The tax code rewards money you don't take as income. Here are the 3 strategies that could save you $20,000. Strategy 1. Max out tax-advantaged retirement accounts. Here's how this actually works. Let's say you make $100,000 per year. Most of your income falls in the 22% tax bracket, meaning the last dollars you earn are taxed at 22%. If you contribute $10,000 to a traditional 401k, that money comes out of your taxable income. So instead of paying tax on $100,000, you only pay tax on $90,000. Your tax reduces from $17,053 to $14,853, $2,200 saved. The money still grows in your account. You're not losing it. You just won't pay tax on it until you withdraw it in retirement, when you'll likely be in a lower tax bracket. Strategy 2. Hold investments for the long term. The tax code treats investment profits differently based on how long you hold them. Short-term capital gains. You bought an asset and sold it within 1 year. This is taxed as ordinary income at your regular tax rate. Long-term capital gains. You held the asset for over 1 year before selling. This is taxed at preferential rates, 0%, 15%, or 20% depending on your income. Here's what this looks like in real numbers. Say you make $10,000 profit on a stock you held for 6 months. At a 22% tax rate, you pay $2,200 in taxes. Hold for at least a year and a day. That same $10,000 profit gets taxed at 15%. You pay $1,500. Same stock, same profit. You just waited longer, and you saved $700. Now scale that up. On $100,000 in investment gains, the difference between 22% and 15% is $7,000 saved. The government wants you to invest long-term instead of day trading, so they literally cut your tax rate in half. Strategy 3. Restructure as an S corporation. This is the big one, and it's confusing, so stay with me. When you're self-employed, a freelancer, consultant, contractor, you pay 2 types of tax. Number 1, income tax on your profits, like everyone else. Number 2, self-employment tax of 15.3% on all your income. This covers Social Security and Medicare. It's basically the employer and employee portions combined, since you're both. So if you make $100,000 as a sole proprietor, you pay $15,300 in self-employment tax before you even calculate income tax. $15,300. Just gone. An S corporation flips this. Here's how. An S corp is a special tax classification. You create a corporation, then elect with the IRS to be taxed as an S corp. The business doesn't pay corporate tax. Instead, profits pass through to you and you report them on your personal tax return. But here's the key. You become an employee of your own company. You must pay yourself a reasonable salary for the work you do. Let's say $60,000. This salary gets hit with that 15.3% payroll tax. That's $9,180. But the remaining $40,000, that's distributions. Distributions are your share of the company's profits as an owner. Think of it like dividends from stock you own, except you own the whole company. As the shareholder, you're entitled to the profits. Here's the magic. Distributions are not subject to that 15.3% self-employment tax. They're only subject to regular income tax. So instead of paying 15.3% on $100,000, which is $15,300, you only pay it on $60,000, which is $9,180. That's $6,120 saved every single year. Now, the IRS isn't stupid. Your salary has to be reasonable for your industry and role. You can't pay yourself $20,000 and take $80,000 in distributions. They'll audit you. The salary needs to reflect what you'd pay someone else to do your job. There are costs too. You need to run payroll, file an 1120S tax return, probably hire an accountant. But for most people making over $60,000 in self-employment income, the math works out heavily in your favor. When we add everything up, $2,200 saved on retirement accounts, plus $7,000 saved on long-term capital gains, plus $6,120 saved on S-Corp structure. That's $15,320 saved per year. Round that up with some additional deductions, legitimate business expenses, maybe a home office deduction, and you could push towards $20,000 or more in total tax savings. And you didn't have to hide any money or cheat. You just followed the tax code explicitly and saved money you don't have to pay. Here's the truth. The tax code is 7,000 pages long. Most of those pages aren't there to confuse you. They're incentives. Tax breaks for retirement, lower rates for long-term investing, deductions for starting businesses, credits for education, healthcare, charity. The code is basically saying, do what we want to encourage, pay less tax. Wealthy people have accountants and tax strategists who read those 7,000 pages. Everyone else pays the default rate and assumes that's what they owe. I'm not saying you should do exactly this. An S-Corp might not make sense for you. You might not have investment income. But somewhere in that tax code are strategies designed for your situation. The system rewards people who understand it. Now you're starting to understand it. One important note, tax law changes constantly and varies by location. These strategies work in the US, but rules differ everywhere. Always consult with a qualified tax professional who knows your specific situation before making major changes. This is strictly for educational purposes, not personalized financial advice. What's your biggest tax question? Drop it in the comments. I'll answer the top ones in my next video.